Hi, this is Josh Frazier, Chief Investment Officer of Frazier Financial Advisors. We wanted to share some timely investment content for our clients. We hope you enjoy. Tax season has started. A lot of clients have gotten us their information, which we appreciate. If you have not received your organizer from us to kick off this process, let us know, and we can get that ready for you. We appreciate getting information as quickly as possible so we can get things done by the April 18th deadline this year. As far as our office space, many of you are aware that we are transitioning to Lane Avenue in Upper Arlington. That will not occur until the end of tax season. So we will maintain our Dublin office all the way through the end of tax season, April 18th this year. We will start taking some meetings and have some activity on the Lane Avenue location in mid to late March, but Dublin location will be open all the way through mid-April. We will let you know if you have a meeting with us which location to go to. Perhaps top of mind for a lot of people is what's going on in the markets right now. So we'd love to share our thoughts on what's going on so far and what we're thinking about it. I think historical context can help set the stage for how we look at the markets today. So what have stocks done for us over the long term? Why are we in the stock market? I often tell clients the whole reason we invest your money is things get more expensive in the future, and we need to keep up with inflation and hopefully exceed it. And stocks have done an incredible job doing that over long periods of time, far exceeding returns of people sitting in just cash or other short-term safe investments. And the reason you can get such great returns in stocks over long periods of time is that over short periods of time, there can be painful ups and downs. And if you can stay invested and ride through those cycles, you are likely to have very good returns. Time horizon is incredibly important. The longer the time horizon, the more likely you're going to get good results from your stocks. So we only invest long-term money in the stock market. And with a 5, 10, 15-year time horizon, stocks have done very well for investors. The last 15 years have been eventful in the US stock market. We've had the tech bubble bursting in the early 2000s, global financial crisis in 2008 and 2009, a nice bull market from 2009 all the way up to COVID in 2020. Take note of that nice return we had for about a decade from 2010 to 2020, because we'll talk more about that on the next slide. The great decade of returns from 2010 to 2020 was not without a lot of volatility, lots of ups and downs, lots of reasons to be worried. However, investors tripled their money over that decade. Patient, long-term investors were rewarded. On average, we get a 14% decline every year in the stock market, sometimes more, sometimes less. Right now, we're sitting at a minus 12% correction, so very normal, something we see quite often. The events surrounding it geopolitically are unique and definitely something to keep an eye on, but so far, this is a pretty normal market correction. Speaking of corrections, the definition of a correction is typically a minus 10% event in the market. Minus 20% is often called a bear market. Bear markets are less common, happening on average once every 6 years. And despite that 6-year time frame in between them, they usually take only about a year to recover. There's a saying that the economic summers are quite long and the economic winters are quite short. The media headlines at the time always seem scary, different, unique, but looking back in time, there were so many reasons to be upset or worried or nervous about the economy or the markets. This is just big events since 2009. We can go back even further in history. Markets have endured wars, pandemics, major geopolitical events, and with a long-term focus, have trended higher. Under short time frames, say calendar years, stock market returns can vary greatly. We can have very good returns and not so good returns. This may surprise some people. If we look at the time frame between 1926 and 2013 and looked at periods of time where we have some major war and times where we don't, wartime has actually been a better performing stock market. We aren't saying that's going to happen in the future, but I think it provides interesting context for investors. A lot of the world's amazing companies were formed during bear markets or right after them. Many of our seasoned clients grew up going to school during the Cold War. They would do air raid drills, get under their desk. They remember gasoline shortages and waiting in line, only allowed to get gas on certain days based on your license plate number. Some of that echoes today as Russia has invaded Ukraine and a Cold War conflict has started again. Markets have seen a lot of these events over time, and what is different this time? According to research from Vanguard, a good financial advisor can add about 3% per year of value to their clients. One of the main components that they can add value is behavioral coaching. It's kind of a fancy way of saying buy low and sell high. In the moment, it's very challenging, and we'll spend some time today talking through the markets, what's going on, and how to make good decisions. As many of you know, I have a 2-week-old baby at home. I'm recording this February 24th. Last night I had the graveyard shift with the 2-week-old, so I had the privilege of holding her and giving her a bottle till about 2 or 3 o'clock in the morning last night. Sadly, we were watching CNBC, BBC, CNN, Fox News, MSNBC, the coverage of what was going on in Ukraine, and hearing bomb raid sirens go off in a peaceful city full of civilians was definitely something I won't forget. So when looking at this conflict, we know that there's a lot of human sacrifice and toll that will occur. However, our job is to focus on the economic side and helping our clients make smart investment decisions. But we don't lose sight of the fact that there's a lot of humanitarian issues and casualties that will occur in this conflict. Let's talk about some of the specifics that are occurring in the Russia-Ukraine conflict. Sanctions are the main tool that the US and Europe and their allies are using to push back on Vladimir Putin and the Kremlin. It's a way to inflict harm on the economy of Russia without putting boots on the ground from a military standpoint. Time will tell if those sanctions will work, but most sanctions will also hurt us as well. So the goal is to find the perfect sanction that will inflict pain on Russia, but not as much on the United States. The invasion of Ukraine was very swift, some calling it a shock and awe campaign. This may lead to a short-term conflict, maybe days, weeks, perhaps months. Russia's military is so much more powerful than Ukraine that a lot of experts are thinking this will be a relatively short conflict. Russia's stock market is only about 0.5% of the global stock market. Ukraine's GDP is the equivalent of 16 weeks of sales for Walmart. However, this understates their global importance. Russia, Ukraine, and surrounding countries are major players in the global trade of very important commodities, including oil, wheat, and uranium. So disruptions to this region of the world will have far-reaching side effects to the global economy. Because of high energy prices and some belt tightening from a budget standpoint the last few years, Russia has a strong balance sheet and lots of cash to weather a financial storm. With over $600 billion in a rainy day fund, Russia can likely ride out sanctions for a fair amount of time. Russia is also relatively self-sustaining from a trade standpoint. They grow a lot of their own food, they have a lot of their own energy. Their main import they're reliant on is technology, a lot of times from the US. That's where sanctions will focus to inflict pain on Russia. A major concern from this conflict is what does this mean for China, especially US-China-Russia relations. Perhaps optimistically for the US and its allies, China does not have near the financial flexibility that Russia has. China imports a lot of their own food and energy and is heavily reliant on global trade. China would be less likely to be comfortable with a disruption to global trade than Russia. This likely bodes well for a shorter, less severe conflict. So what does this mean for your investments? If you're in the phase of life where you are saving and adding money to your accounts, this is likely a great place to put money to work. If you have extra cash that you don't need in the next couple years, we suggest putting it to work in your investment accounts. One of our favorite investors often says the future is uncertain. And because of that uncertainty, We have lots of things in client portfolios to buffer against short-term downturns. Clients who are taking withdrawals from their portfolio have 3 or 4 or 5 years of income needs that are invested in things that are not stocks. And those are often gold, timberland, short-term bonds, and those are actually performing quite well right now, doing exactly what they're supposed to do, so that clients will not have to modify their spending or take a reduction in their standard of living in retirement. Here's a snapshot of the US stock market today. I think it's quite interesting. The day that Ukraine was invaded by Russia, the US stock market closed positive after spending much of the morning sharply negative. Short-term movements are almost impossible to predict, so we don't try to. As many of you know, when the market moves a lot, say down minus 20%, we start to make very, very targeted buys. But that 0 to 20% correction, in our view, is a normal enough occurrence that we make small reallocations, make small buys, but don't make wholesale investment changes until the market gets a little cheaper than where we are today. I'll leave you with 2 parting thoughts. The first around fulfillment and contentment with finances. Tony Robbins wrote a book about this concept, and he found that people who felt like they had a plan and were making progress towards their plan were getting greater fulfillment from their finances. We see a lot of clients accumulate a nest egg and save so hard for retirement. And our job is to help make sure that that nest egg is not a source of stress, but instead a source of fulfillment. Lastly, I'll leave you with one of my favorite investment analogies. Thinking of an investment as if it's a duck swimming across a pond. Looks very calm on the surface, but underneath there's lots of legs paddling pretty hard. And that's how your investment accounts are. From a day-to-day basis, there's lots of investment opportunities being taken advantage of on your behalf. We look forward to speaking with you soon and seeing lots of our clients during tax season. Thank you.